understanding venture capital and founders' misconceptions about it, when to seek funding, the importance of product market fit in retail, and the growth of crawl, walk, run. This week on the show, we have Anna Whiteman, who is a partner at CPG firm Coefficient Capital. Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We follow the flow of money between founders, investors, lenders, and everyone else in the ecosystem to ultimately answer the question, is D2C and CPG still a good business? Hope you'll enjoy the show. So Anna, in pre-recording, we were talking about how founders today are fitter than ever. 15 years into a wave of challenger consumer brands, raising growth equity, there's much more sophistication. But what do consumer founders still misunderstand about raising money from institutional investors?
Yeah, I think one enormous thing that is kind of undervalued and underappreciated is that when you take venture money, the clock effectively starts for when that venture money is going to be returned to the venture fund. So I think, it's amazing when founders can find partners that are aligned and kind of you always have the mindset towards building long-term brand, building long-term partnerships, and growing as kind of efficiently and strategically as possible. But it does kind of matter for venture funds when they return their capital. So I think, number one, I think really having founders scrutinize whether or not they're a venture backable business or if their model necessitates venture money or kind of a different form of funding, whether that's more kind of debt funded or it's equipment funded, like whatever it is, finding creative capital to get you going that doesn't necessarily start the clock of venture return money. I think founders need to know that that's always going to be something in the back of the mind of their partners when they kind of get into business together. So that's one thing that I think is a little bit misunderstood. And I think so finding that like alignment and that partner that's so deeply embedded with your mission and your differentiation and your reason for being is really, really important. And then I think, one thing that when we were talking about this, just building over the last kind of 3 to 5 years in an ecosystem of scarcity versus building in an ecosystem of relative abundance in terms of capital markets, a lot of the kind of what I hope to see when founders come in to pitch me is that they're operating from a place of strength, meaning they're coming in, they've nailed their gross margins, they've nailed what their unit economics look like, and when they come in to raise venture money, they know that they're putting it behind the most efficient growth levers that exist within that business, rather than just raising it to have a comfortable buffer on their balance sheet and optionality to try and test new things, which obviously some bit of it has to be used for, but really kind of being efficient and practical with your use of capital, because I think again it was taken for granted when we were in a period of capital abundance that everybody had a relatively kind of soft, cushiony balance sheet, and a lot of that money was misspent, and it wasn't operating from scarcity and operating from resource constraint forces this creativity and this agility in how you kind of build your business and build your growth. So I would say the two misconceptions are whether or not you actually structurally need venture money and when, and then kind of the use of proceeds and operating from a place of strength and really putting that money into kind of growth and profitability driving facets of the business rather than experimentation, novelty, and really staying disciplined as a use of proceeds is something that founders, I think, can be like directly attuned to when they take venture money.
So Anna, you talked about founders thinking about whether they're actually venture fundable. And again, I just want to, there's a lot of nuance in that. Does that come down to TAM? Does that come down to founder ambition? Because a single SKU, single channel looks very different to a portfolio of products in multi-channel 3 to 5 years later.
Yeah.
How should a founder think about, is VC the right track for me?
Yeah, I think, we're in the business at Coefficient of investing behind a lot of more fast moving consumer goods. So we tend to have a relatively good understanding of what typical growth curves look like per category, typical gross margin structures look like per category, typical, distribution like unlocks look at every stage of growth. So we kind of know exactly how much money a company should or theoretically does need at each stage of growth. And so, like, we have a great model for what venture fundable looks like versus not. I think when you start to get into, other business models where it's very, take like plant-based meat, for example, as a category that had so much R&D, so much really important like science and development going into it at the beginning, but it was so kind of all of the products were so pre-commercial. So there was, regulatory approval that needed to happen for a lot of the types of product innovation that were coming out. There was how do you get the price point down to commodity levels of like parity with, plant-based protein alternatives to their commodity alternatives. So there was a lot of just new, novel TAM clearance that needed to happen for those companies to then actually exist and prove growth. So I would say knowing a little bit more about whether you're still in science and experimentation mode versus whether you're in commercial growth mode, because I think one thing that, as we said in the beginning, is kind of the clock starts when you take venture money for how you're going to return that capital and how everybody's going to win. And I think that kind of having the growth plan and having the business model pretty firmly in place. And again, venture exists because we're subsidizing trial experimentation and getting to what works and getting to truth. But I think minimizing the volatility of what that experimentation means for you or your business and having really strong like structural foundation and then taking venture money to back that. That's kind of the plan that we usually invest behind. But yeah, I think just understanding, then you get into categories of consumer that are four wall and you're looking at, way more kind of like a real estate model and knowing, in what you're building, all of the different financing options available to you and which ones are going to be most, brand friendly and founder friendly versus which ones are really going to be, growth subsidies for you. I think it's important that there's kind of more transparency in all of those alternatives for founders today, and getting smart on that at the earliest stages of your business is like a big asset for founders, I think.
And does that mean Coefficient has a deeper perspective or more of an operational playbook? Said another way, are you more okay with a founders coming in and being like, hey, I've built really early stage, good gross margins, I've got good consumable retention curves, but I need help with retail distribution, thinking about kind of working capital dynamics of scaling from 20 to 50 to 100?
Yeah. And I think that's where we come in and we have very much this like partnership model, which is we know how much it costs to build, you know, 10 different categories at retail, at, conventional grocery, at, in beauty retailers. So we kind of have down to that granular level of build. We know how much it's going to cost and how much a business can actually absorb given their gross margin structure and given their profitability structure. We can underwrite. What I think is interesting is a lot of the businesses that we see have strong, digital and D2C models before they end up launching retail. So we can kind of have a very true picture of who the consumer is, how often they're consuming it, what the patterns look like. And then, we can apply that playbook and tweak it and model it to how the consumer actually acts in the real world when they're out at Whole Foods or Target buying a product. So we love that. We don't necessarily need infinite data on how a product is going to turn on shelf. We can try to accurately model that ourselves and be predictive around that ourselves. But I think what we like to do is stop and check how the data is performing every month, every 2 months, and see what the velocity looks like. And we're very agile with the capital from there, which is where do we spend smartly rather than just kind of blanket cash all over the place and see how it turns out. So I hope that answers your question. But yeah, we try to be
No.
partnership oriented and really calibrate towards category, product, and like phase of growth.
Going from early D2C success and into retail, I'm sure you've seen both within portfolio, but then more so everything else that lands on your desk. We've certainly seen it most of the time when it goes sideways. Maybe can you share learnings of what are some commonalities between successful companies that make that jump and then ones that make that jump but then struggle with the sell-through? And for us, outside looking in, because we are not retail experts, so much of it just is that ephemeral product market fit,
Yeah.
and really hard to predict. But I'm sure there's more kind of bottom-up tactical elements that make it work better.
Yeah, to some degree, there's always just luck assigned to it, right? And I think you can do as much as you can to derail. I'll talk about the parts that I think that you can control, rather than sometimes you just put something on shelf and you don't realize that the packaging it's just looks see through on a shelf. So that we'll take that out of the equation. I think one thing that you said there that I'll double down on is you really need to understand product market fit. And I think, one thing in the 0 to 5 or $0 to $10 million phase that you should be inherently tuned to is I think founders start their business with this idea of what they want it to be, and their consumers actually receive it in a totally different or even slightly different way, but really kind of being receptive and open to how people in aggregate are accepting your product and using your product and loving your product, and then making sure it's way less simple to reverse course once your inventory is landed in a retailer's warehouse and your product is sitting on the shelf. It's way easier to kind of manage and play with the controllers when you're selling D2C or when you're selling e-commerce. So I think that's that just knowing and inherently getting that product market fit before you make the plunge into retail, I think is important. And then I would say a mistake that we typically see made when launching retail is going broad on one retailer, all in on day one. I think founders should know that they have a lot more leverage with retailers than they think they do. There's going to be a lot in a retailer that's going to be hard to swallow. There's slotting fees. There's all of these kind of complexities that make the cost of doing business there really expensive. And so I think the trade-off for founders is that ask to go into a sample set of stores, ask to go into a small footprint, spend a month standing at those doors, talking to consumers, seeing how it looks on shelf, seeing what the velocity data looks like, and then understanding what levers you have to move the velocity in your category up, or how are you creating shelf productivity for the retailer and create like a cooperation scenario that then gives them all of the data that they need to then roll you out to national. So I think starting with a small footprint and learning as much as you can early before you go broad is the best way to make a real partnership work with your retail partner. And then I would just say, I kind of glossed over it there, but staying so married to the velocity data. I think there's a million scientific ways that you can look at velocity data. You can look at, when your product is on promo versus when it's off promo, and analyzing how much. I don't know if founders on D2C appreciate this so much, but you can kind of create and build your own retention curves for a consumer in retail if you're really tweaking the velocity data or studying it as kind of granularly as possible. So I think just the Bible of product turning on shelf is really going to lead you. So follow your hero SKU, get double facings for your hero SKU, start small, broaden out, piece by piece. And then I think continuing to kind of the playbook in retail, as long as I've been doing this, has remained relatively the same for food, bev, beauty, which is, start at a smaller retailer, build your way up to the big retailer. Don't, have your eyes set on the end of the road before you've actually launched. It's kind of what is it? Crawl, walk, run. Start crawling, then walk, then run. And ultimately, you will get to Costco, you will get to Walmart, but be steady and measured as you get there. And I think that's kind of the approach in the playbook that we take.
AI, AI, AI. Everyone's talking about it, and you're worried you're getting left behind. Meet RichPanel, an AI-first customer support platform that's built for one thing: making support faster, smarter, and cheaper for e-commerce brands. Something you can actually feel smarter about using. RichPanel combines a unified inbox across email, chat, and socials, a customizable self-service portal that customers actually use, and Sidekick AI, powered by GPT-4, which learns from your past tickets to suggest on-brand replies. Does it actually work? Well, with RichPanel's guarantee, you get guaranteed 30% cost savings when you switch from Zendesk or Gorgias, 30% automation to reduce your ticket volume, and a no-risk guarantee that if Rich Panel doesn't deliver those results in 60 days, you get a full refund. That's why top brands like Ridge Wallet, Jones Road Beauty, and Pella Cases are already using Rich Panel to save hundreds of thousands in support costs. Time to start letting AI work for you. Head to richpanel.com and start your free trial today. Real savings, real automation, real AI that actually works. And then let's just talk about the cadence of that, of the kind of crawl, walk, run. We spent a lot of time with a CPG founder in the kind of call it $10 to $15 million revenue range. So half D2C, half retail. Businesses at a decent spot, but their retail distribution, they were in specialty, they were in natural, they were in Target, they were pitching for Walmart. They had different product assortment and packaging for different channels. And then we're talking about that relative to both the operational complexity from an inventory and working capital standpoint, but there's also the team component to stand that up. And I was just sharing with them, I was like, are you too complex too early? And can you win at all these places at your current state, potentially undercapitalized? Yeah, I'm just curious about kind of, back to the cadence of literally the timing of like, what do you like to see in year one, year two, year three of the how quickly are you learning from crawl, walk, run?
Yeah. I think it's a great question, and there's a million different ways. Was this a food or bev company that you're
It was not. It was like a in the home care.
home care? Okay, cool. It cuts differently a little bit across category, but I would say, first of all, it's the interesting kind of conversation we were having earlier around toggling growth and profitability. I think and you're a founder, you're going to be in a growth mindset. It's going to be exciting and attractive for you to open up and unlock a new distribution channel. That's going to be, it's what you build a brand for, right? It's the build. So what I think founders don't necessarily think about when that is happening is how costly it could be to unwind that if it doesn't work. And so I think really kind of, I'm so of the mindset that it's just trial, learn, repeat, trial, learn, repeat. And so I think, like, as I think about it, I'll answer it from the standpoint of a growth investor and we do things from Series A through pre-exit. What we like to see kind of in the, call it 0 to 5 million, $0 to $10 million range is honing in on the product market fit, being married to the customer data, being married to the retention data, being married to the reviews. What do people love? What do people hate? And just perfecting your product and your audience and your sell, and frankly just your differentiation, because consumer is such a loud category. There's so much competition in no matter what you create that you think is so super differentiated, there's going to be a million people that either exist in that category or will come into that category. So honing in on your special like superpower, that's kind of the seed into the Series A phase. And then Series A, I think Series A and Series B, which I would classify as like we're kind of 5 million plus, and we're writing checks 5 to 20 million. That's really to subsidize that efficient growth curve that I was chatting through earlier, which is new distribution unlocks, but smart kind of incremental distribution unlocks. Trial and experiment with new product development, but all within the frame of what are your consumers responding to? What are they loving? And then on top of that, I think it's just, it is trying new things. Like, again, I go back to like why venture exists, which is you need to take some risk. Like there's risk inherent in our business. There's risk inherent in starting a company. So try things that you think will work. Some of them will not work, but fail fast. And that's kind of what that Series A to B growth curve should look like. And then I think, in consumer, obviously everyone loves to see $1 billion exit. I think a lot of consumer brands build into that 50 to 100 million, at which point you should be profitable. You should be, if you're raising money, it should be to support existing growth where it's working. And you should not at that point be subsidizing channels or products that are really just noise, and complicate your story. So I think that 50 plus $1 million, revenue, that's kind of just to get you to a point where in whatever category you're in, whether it's beauty and it needs to get you to 100 million, or you're a food brand and it needs to get you to 150 million in top line revenue and profitability, you're really kind of calibrating at that stage around the growth and the EBITDA that your ultimate either acquirer or, financial sponsor will find you an attractive acquisition target at. So that was an unsexy way of answering it and a very non-creative way of answering what I think the crawl, walk, run looks like and the most capital efficient way to get to that. Because you want to get to run, but you have to kind of step your way into it.
Let's talk more about the running and specifically the exit marketplace. It's been a pretty hot last 12 months. And maybe we'll start from a standpoint of strategics, because I think it's still largely misunderstood from emerging founders, like what strategics are looking for. You recently had a portfolio company exit to a strategic. You spend time with the incumbents, with the corp dev teams at the incumbents. Like, how should a founder think about, every founder dreams about the 5 times revenue exit. So how can they achieve that?
Yeah, I mean, I think it's great when that happens. I think you have to consider that an anomaly. And I think the ones just availability bias and what we're seeing on, LinkedIn and in headlines is going to be the sensational exits that we all want to, build around. But I think staying disciplined and really building into, I think, we've been in a period of time. You and I having this conversation 5 years ago would have brought out a totally different answer, which is like, it's okay to be burning, 50% EBITDA loss and, growing at 300% year over year. That's what people want. The tides, as you know, quickly shift and tariffs can change everything and macroeconomic policy can change everything. And, a strategic just not having a strong enough balance sheet or having, board approval to make an acquisition can change your entire outcome if you're building for that strategic specifically. So I think founders staying very attuned to, like, what we try to do is really just know what the gaps are in strategics portfolios and find companies that will fill those gaps. And those kind of the chessboard can change over the course of our investment period, but just knowing where they're calibrating and where their appetite is. If, you think of a potential acquirer as like, of course, they're the natural acquirer for a color cosmetics company, but you're thinking that because they have a million color cosmetics companies in their portfolio, they might not need what you're building. So staying really attuned to what people want to buy. And I think, ultimately it's very nuanced, and I think Carol Hamilton at L'Oreal, who's just left as their head of M&A, did a great job of saying it. Like, it's all of the things can be true, and all of the aspects of your business can be perfect, and it could be somebody woke up on the wrong side of the bed and vetoes the deal. So like everything has to go right for an exit to happen. I think what strategics want to see right now and what they've wanted to see for the last 3 years, just given the volatility in the environment, has been, you know, solid EBITDA margins for your category. I think in the categories that we play, call it food, bev, beauty, that means anywhere like 15 to 30% EBITDA margins by the time you're exiting, which if you're at, 75 to 100 million in revenue should be something that you figured out at that point. So I think we like to invest in those brands that we can kind of see a path towards that, across an omni-channel business. And we try to build in that disciplined fashion. One thing that I think's interesting, and this is kind of even as I grow and I scale as an investor, I started my career in a growth investing period where you were subsidizing losses and growing at all costs. Then I went into a little bit more of resource scarcity and constraint and get everybody to profitability, and growth is, the toggle and turn off growth and just get yourself to health. And now the green shoots this year that we've seen have been acquirers are buying growth again. I would not generally say that like we're back to the rah-rah go-go years. Like there's so much that still needs to be proven. But I think what's been great about founders that I've at least chatted with and who we've invested behind in the last year is that they were born of that environment where they understand growth and they understand profitability and they understand how to toggle between the two. And I think there's just a discipline in a growth curve now that profitability and at least, very limited subsidized losses are an inherent assumption in the business model, rather than like, okay, we have to nuke our competition out of the environment. And I think strategics appreciate that, and I think they're getting back to the table. We've seen a lot of good beauty exits. I think companies in food and bev need to think that they're going to grow to be, bigger and bolder than they were being acquired for 3 to 5 years ago. And so really just having a strong business model that supports growth past, 100 million up to 150, 200 million. You need to have that mindset when you get started. But we're, inevitably bullish and optimistic that the acquirers are not going away. Their patterns for buying just change, and we're calibrated and we're listening to that, and we're building companies that fit what they're buying for. And it's product above all else. Like all of these things can be, finessed in some capacity, but unless you have an incredible product that people love and can't be reverse engineered, none of these conversations are even worth having. So that's where it really starts. And I am so optimistic about, the exits that we're going to have across consumer for the next, 3 to 5 years.
What I want to tell you about today is Parker credit cards. Look, there are multiple subreddits dedicated to credit cards points hacking, and I get it. But what do entrepreneurs really want in today's market? Help managing their payback windows when acquisition starts ramping. With Parker credit cards, you get up to 90-day repayments on ad spend to help you on your cash conversion rather than having all that upfront ad spend before revenue starts coming in. Parker allows you to spend aggressively while still managing cash flow, including meta spend. So instead of hunting for best points or cashback programs, realize that the best ROI is to be able to increase your ad spend without hurting cash flow. Go and check them out. Parker credit cards at getparker.com. That's getparker.com. Parker is a financial technology company, not a bank. The Parker Commercial Credit MasterCard is issued by Patriot Bank and a member of the FDIC, pursuant to license by Credit Card International Incorporated. You have one of the must-reads of the industry, which is your Consumer Trends Report. I think you guys release that a couple of times a year. For people who aren't familiar, can you maybe share a teaser or a couple of highlights from the most recent one?
Yeah, definitely. The most recent one we did was a beauty one. I think the flashpoint. So to give context on the Consumer Trends Report, we started it with Dan Frommer from the New Consumer, who's kind of an insights, longtime consumer journalist. And our reason for being is to really get to truth, our own truth. And we're talking to consumers. We're talking to thousands of consumers that are answering our survey and panel questions. And I think there's just not a lot of noise, and there's a lot of different opinions floating around. And what we're trying to do is talk to the consumers themselves, see how happy. One metric that I love that we track is just a life satisfaction score. So longitudinally, we've been tracking this for the last, 5, 6 years. And we understand how over time, given everything that's changed, COVID, and then, inflation and all of the givens of the last, 5 years of life, how people's happiness and satisfaction with life has or has not changed, and what appetite is and how resilient the consumer is for spending. So we cover a lot of ground. It's very kind of macro, and then we'll go micro into multiple topics. So we'll do a food and bev specific report, once a year. We'll do a beauty specific report. And then we'll have this kind of biannual summer and end of year full report. The last kind of big flashpoints that we've been tracking, which I'm so interested to just see the trajectory of, is like TikTok Shop coming up. That's been one that people have really latched onto. And I think we've been helpful, at least in providing ground data around like who's on TikTok Shop, what the purchasing patterns look like. Are people first purchasing on TikTok Shop, discovering there, and then navigating their way to a D2C or an Amazon site to replenish? We kind of, one of the bigger headlines from the last one was that TikTok Shop had grown in the course of the last 2 years to be larger than Sephora and GMV. And so it's an overnight sensation. It's where attention and across generations, but a lot of young people are spending time just hanging out and shopping. And so we're trying to really kind of parse those patterns and see how that will factor into the future of, consumer buying habits and the consumer economy. So that was an exciting one. What else has come up? During COVID, there was a funny stat that like crab purchasing had gone up like 100, like more than any other food category. People were buying way more crab when they were at home. And but we've covered, longer term trends like non-alc, just trying to get to truth on, is non-alc, the next big shift in consumer habit, or is it a flash in the pan that we'll all have been scratching our heads wondering what we were doing investing in, functional spirits 5 years from now? I think we're trying to get to that answer quickly rather than rely on a handful of research reports and opinions. So that's the consumer trend report.
Amazing. Maybe related to that, is there a tech channel tactic that you're excited about that you've seen work in portcos, or maybe just said more generalized in another way? Is there a piece of advice that you'd have for founders in 2025?
Yeah, I think the social listening tech has been impressive to me how that's emerged and scaled. I think what you've seen, and frankly, this is something that I'm still studying, what we're shifting from in terms of how people are consuming, and as much as digital has become a form of customer acquisition and a form of brand awareness and marketing, you've seen this shift from a Instagram kind of like post behavior to it needs to be subtle and it needs to be in the background and it needs to be kind of very audience targeted. So, I saw a very cool company the other day doing social listening, and they can kind of like use AI to identify even if the product is just in the background of a post. So a brand can then amplify that post and get it out to a very specific subset of consumers, women in Florida who are interested in, you know, energy drinks that are between the ages of 20 and 25. So we're getting so pinpointed and granular on how brands can see and understand and hear their data in real time and then reserve it to their audiences. So I think that's a really interesting shift. I mean, TYB is not necessarily new, but I think some great brands are using platforms like TYB to just co-build their brands with their communities. And I think that serves as kind of the greatest petri dish for why a brand deserves to exist is if somebody's logging into a channel to talk to you as a brand every day and give you insights and opinions, those are going to be your hardcore evangelist consumers that are going to start to scale with you across channels and across growth levers. So I think that social listening and that ability to just really tap into deeper, nuanced insights behind your product market fit will be really powerful for brands. And then I think it's coming up more and more like experiential and just I think we've all kind of like recessed into this world behind a screen for the last several years, and what people are realizing is that they want to be in a running club, they want to be engaged with other people, they want to talk. And so there's really cool apps. I think Sweat Pals was one that I recently talked to, that are bringing people together in real life, and brands are engaging with those more like micro communities. I know that sunscreen company Vacation is hosting walks like in various cities where people just go and walk, and it's almost like they're not overtly nobody's trying to overtly sell you a product. I talked to a company recently that was filming short form content, and they're making a television show, and you have to really like click triple into that television show to figure out that it's associated with a brand and a product. But if you've done the work to get there, you're going to buy the product. So I think brands are getting smarter about listening to their communities and then actually living inside of their communities and kind of in the petri dish with them to really create brands that have emotional resonance and tethering to the consumers that they serve. And I think those tools will only get more sophisticated as more content and data is released into the world about how people are interacting with their brands.
I have to ask the follow-up question of, as an investor, how do you digest these brand activations and these brand marketing budgets? I imagine, or maybe I'll ask the question, do you prefer a brand that's coming to you and being like, hey, we're growing with direct marketing, put in X, get 3X return, here's the working capital model,
Yeah.
thus another brand saying like, we're going to do 100 walks next year. And
Yeah. I think, first of all, I think it has to be both. I think you have to fire on all fronts. I do believe that consumer is different than other categories of investing where emotional resonance is an enormous moat. And so you have to have that level of real world engagement. We're not building software products, we're building things that people love and need in their home. And a lot of what you love and need comes from a place of emotional, like, does it provide you joy? It can provide a service, it can provide a function, but so can 10 other brands in that category provide that service or function for, probably 10% less, 50% less. So I think I might be a Luddite in this regard, but I think there needs to be like love. There needs to be evangelism. And frankly, one way of actually, if you want to like really be attribution oriented towards this, is we look at like organic customer acquisition versus paid customer acquisition. And the best brands that scale start with strong organic customer acquisition ratios. And what that means is people are just that you get your hands on it and you have to tell 10 of your friends about it. And affiliate marketing is making a comeback now too. And I think what it is people, really connecting in both a functional and an emotional way. And you can be measurement oriented around that emotion. There's ways to get around it, but some of it is just it's going to be maybe a loss leading experimental activation that creates buzz, and you can't attribute and you can't create an ROI around it, but it's important for brand and it's important for connectivity.
Anna, as we head towards a wrap here, is there anything you're seeking from listeners, types of brands that you want to be seeing, and anything that you're seeking from the universe?
Oh my, what am I seeing from the universe? A lot. um, Yeah, I think, first of all, I want to be proven wrong on any of this. I want to be told, what I'm totally missing, what my blind spots are. I think we can look at everything in our ecosystem and still miss the myriad of awesome products that are being built out there. So I'm particularly keen on getting ahead of just what consumer AI is going to look like and how that's going to transform things like Duolingo, things like Strava, things like, the apps that we know and love and interact with every day. How is that going to become so much more powerful and so much more generative in our lives with this new wave of AI? And I think, we're always just seeking brands that have such a unique, distinct voice and reason for being. So whether that's function, tech, IP, just emotional resonance, as I mentioned. So love any of your founders to give us a call if they're at that 5 million plus phase. And again, I just want to know how we can best support our consumer brands in our portfolio. So if there's technologies, if there's new marketing styles, if there's new tools available, I want to know about them like before they're even born. So would love that from your audience.
Awesome. Anna, thanks so much for coming on, and look forward to next time.
Thank you.
And now a brief conversation with Numeral CEO Sam Ross. Sam, you started an e-commerce business, felt the pain of sales tax, nexus, registration, receiving paperwork to deal with. That was the inspiration behind Numeral. Maybe talk about how Numeral is different to the incumbents.
Yeah. So I think, as an e-commerce operator, I always felt like I just had so many tasks to do. And there's certain tasks you really want to put your mind to, whether it's product development or planning for your next order, marketing, things like that. But you end up, I kept getting bogged down by all these kind of low value brain damage work, including, sales tax, where it just felt like every minute I spent on the phone with Department of Revenue, West Virginia, was like not actually like growing my business at all. And it really felt like a waste of time. And so, there's some of these incumbents in the space, and I think very much what they've delivered is sort of the previous generation of SaaS, which is giving you a self-service tool that, you can use to solve the problem. But to actually solve sales tax, so you don't have to actually think about it, requires you, again, you're getting physical mail from 40 plus states and reading all that mail that comes in because it can be important change on your account. You might be calling a state when there's an escalation. There's all, determining what type of product your tax category your product is in, and there's all the stuff that comes along with it. And so a lot of friends of mine to manage sales tax, they would often hire fractional CFO or hire someone on their team who's part of their remit was spending dozens of hours a month on just making sure sales tax compliance got done. And I think as an e-commerce operator, you just always want to automate as much as possible everything you're doing and outsource it. But it felt so expensive and kind of crazy to have almost like two vendors to solve sales tax. So I think the original idea around Numeral was not to deliver a tool, although we have a tool you can use, was to deliver something that really felt like an end-to-end service or end-to-end solution with sales tax. And so a couple things that make us different, right? So the first thing is determining where you have liabilities in. So if you go and use an incumbent like Avalara, which is the kind of big incumbent in the space, when I had one of my brands, they said, yes, we can help you figure out where you have sales tax liability, but it's going to take us 3 weeks to figure that out for you. The output of that is going to be a 50-page PDF, and by the way, it takes 3 weeks. And that to me felt crazy. And, it wasn't even like AI or anything you need to solve that. It's just some business logic. So, again, what we do is, at Numeral, you connect your sales channels, whether that's Shopify or Stripe or Amazon. This report is usually produced within 24, 48 hours, and it's free. And then, again, the idea is you actually have a human who could be highly consultative around where you have to be filing in, and it doesn't feel like it's some overwhelming tool that's hard to understand if you're not an expert here.
Certainly one of the low points in my e-commerce career has been losing passwords for a number of states after registration, and then having to call them but play phone tag because their hours are like 10 a.m. to 1 p.m. Send via physical mail a bunch of backup information to get access to the account again. And it's definitely one of the most draining and depressing parts of operating.
Yeah. Keeping all those credentials intact, right? Department of Revenue, New Mexico, Minnesota is challenging. One thing that was actually challenging for us when we started was to onboard someone who was already registered with states. They were on Avalara. Is the first time we log in, we actually would have to get the two-factor authentication code, and so. Any of our users would probably know during onboarding is a step where you book a call with someone on our team and you're reading out these 2FA codes for, it could be up to 40 minutes, in bad cases an hour, something like that. And it's a pretty gnarly process, and we just didn't have, a great way to solve it. Recently though, what's really cool is we actually developed a system that we call it like Plaid for state portals, and you actually, put the username password in, and the back end we're using an AI agent, and we'll actually go, log in there's a browser in the back end. It's logging in. It pings you in the UX, like for the 2FA code. This is just the first time, you're onboarding to us. But now you can actually skip having to book a call, and this whole thing is automated. And we use that technology for other parts of our systems as well. But it's nice, incrementally to like remove all these painful steps for people.
I think one of the still slightly underappreciated components of sales tax, state sales tax, is that there is some personal liability to it, that you can't just say, hey, I didn't know that I had Nexus, or, God forbid that I was collecting but forgot to remit. Yeah, can you just talk about maybe the critical nature and maybe even some of the downside scenarios of not doing this properly?
Right. So again, with sales tax, you have a liability with each individual state to make sure you're registering with them at the right time based on whether you have a physical presence or whether you sold X amount into their state. And it's easy maybe to miss that critical juncture. And so often what we'll see is somebody, they decided, I'm making this up, they decided not to register with California, or they didn't even think about it, right? It wasn't even on their radar. And then it was at some point they get a letter in the mail from the state saying, hey, you've had an employee here, so we know you've had a presence here for X amount of time, or hey, we've seen it seems like you probably should be collecting taxes and remitting taxes here. And then all of a sudden, the business to start is liable for, let's say it's it could be a year, 2 years of taxes that you could have been passing on that cost to the customer, but now you as a business are responsible for that, right? So if you did, making this up, $1 million of sales into California during that time period, average tax rate's a little bit above 8%, let's say, now there's $80,000 in taxes that you wouldn't have had to pay, but now you're paying out of pocket, plus interest and penalties. Those can get pretty large. And so maybe all of your profits are being wiped out. And so some people, they say, well, okay, I have all these liabilities. Maybe I could just go bankrupt. But actually what's insane is sales tax liability, even if your business goes bankrupt, it'll accrue up to the business owner, the officer. And so we've seen people have to personally shell out money to states out of their personal income, their personal net worth, because they were protected by the states. So yeah, that's what makes it so just like such a gnarly problem.
To go on to something a little bit cheerier, I know we were talking about in pre-recording, my words, not yours, but part of the numeral vision is this long march toward giving operating leverage back to founders. And you were saying, 2008 Shopify launches, you remove, a bunch of development costs, and then there've been these incremental steps. And now this explosion in the last 18 months through the use of AI and agents to do a lot of the work. But yeah, maybe just share a little bit of your view on that.
Yeah, I think, broadly, one of the biggest challenges for me always when I was an e-commerce operator, I guess I still am, I still run a business, is there's like the fun, important part, which is, finding product market fit, doing product development, doing the marketing, but you often just get bogged down with, 500 other things, whether that's like, the website development, or it's customer support and all these, and all these things that are not, in e-commerce generally, there's no like individual thing that's particularly hard, but what's hard is there's 200 things to do. And that's why, places like Amazon have been in some ways have been so successful, is because they obfuscate away all the customer support and the marketing and things like this. But I think, the long march that you see here, right, is, early on, if you want to start an e-commerce company in 2007 or so, you have to hire a development team, and it's just millions of dollars to even get off the ground from a technology perspective. And, Shopify is made it easier, but I think, across all categories now, I think it hopefully gets simpler and simpler. And I think the other march that you see as well is, I always operated my businesses very, they're always bootstrapped when I had e-commerce businesses. So always very lean and relied on a lot of contractors and agencies. But, the services are very expensive. And so even things like customer support, that can get expensive. So I think customer support now we're seeing, you can have less and less people on that team because you have AI automating parts of that. I'm sure it's been probably talked about too much by now. Sales tax, that's our goal, is, again, used to have to maybe hire a fractional CFO to manage a piece of software. Now you have a single solution. And so it saves you on cost and time. I think there's lots of other categories that we're seeing this happen in. And so, hopefully the dream is right. One day, you could just be a kid in the basement, your mom's basement somewhere, have a really good idea for our product. And, most of the heavy legwork is actually automated away from design, development, ordering, and fulfillment, marketing, etc. And so, I think that's what's cool about, that's always been Shopify's vision anyway, is, how do you help the rebels win? How do you, there's 2 million plus merchants, but I think there's still always a lot of challenges to go from having something with a little bit of success and actually scaling up and not getting bogged down with, all the financial operations of your business particularly.
Sam, thanks so much for coming on, talking to us about Numeral and sharing some of your vision of the future of e-commerce. And thanks to Numeral for sponsoring the pod.
Thanks, Van. It's great to be here.